Welcome to Investing 101. I wish this video was a class I could have taken in high school or in college, but our education system is too busy teaching us things like Walking 101, which is a real class, by the way. And to think, all this time I was doing it wrong. But Walking 201 is really where it's at because you get to learn how to chew gum and walk at the same time. And that is why today we're getting back to the basics and answering that question, how many stocks you should own. Because if you own way too many stocks, and if you have one good stock pick that does incredibly well, it won't have a huge overall effect on growing your money. And if you have too few stocks, you'd be taking on a higher risk and you could potentially just lose all of your money.
And it's gone.
So it's a great question and one that is fiercely debated in the finance community. So the goal of this video is to get to the bottom of that question, but I want to warn you. Bubbles everywhere. Oh, I'm kidding. As long as Papa Powell's around, none of these bubbles are gonna pop. They're all made out of glass. In all seriousness, I own close to 100 stocks in my Robinhood portfolio. I didn't always own this many. It took me 7 years to get to this point, and I bought them at different price points when I thought they were discounted, which is always when you should be buying stocks. And a couple dozen of these stocks I got for free for signing up my friends and family to Robinhood and Webull, but at this point, I probably have more stocks than I do decks of cards. Nope, that is a lie. I still have way more cards. Hi, my name is Andre Jick. Hope you're doing well, and the answer to this question lies with just one variable, and the answer is diversification. It's a word you might have heard of before, but if you haven't and you look it up online, it says this: the act of diversifying something, or the fact of becoming more diverse. When you didn't read the book, so you had to BS the essay the night before. But here's what it actually means. It means you take your money and instead of putting it all in one place, you spread it out across different stocks from different industries and different sectors. And this is great because it reduces your chance of having all of your money go down at the same time, and it protects you from the volatility of the stock market. For example, if you bought and put all of your money into something like Apple, that would have been great. You would have made a lot of money. But chances are you would have picked a stock like Hertz, whose ticker symbol perfectly would describe exactly how you'd feel after that. It hurts. Yay for recycled jokes. Imagine this. You find a stock that you absolutely love. It's the crowd favorite and the darling of Wall Street for a hot second. And that company's name was Enron. And Enron was doing some crazy stuff because the stock price was going through the roof and nobody understood why. The reason was because through clever trickery, they were able to hide billions of dollars of debt from their investors, which of course eventually the public found out was hidden in my palm. So that protected their stock price, but eventually they declared bankruptcy, their stock price went to $0, they got delisted of all the exchanges, and people lost their money. But for a while, it was a lot of people's favorite. And it's also the reason why I love dividend stocks, because a company that pays shareholders dividends can't cleverly hide all of that debt away. I'm not sure what playing cards have to do with debt or dividends, but I guess it makes for a good visual. But if a company isn't profitable, then it can't exactly pay money to shareholders that it doesn't actually have in the first place, no matter how much they try to use their clever trickery to try to fool us. But on the opposite side of that spectrum, what if we put all of our money into an undeniable winner like Johnson & Johnson that's been around forever and I have quite a lot of money in it, and it's a dividend payer that has paid their dividends for 57 straight years without missing a beat. Why don't we just put all of our money into that one, because it's got a proven track record, they've been around forever, and people will always need healthcare products, and all of those things are true. But maybe tomorrow we discover that their products cause cancer, and just like that, it's over and the company goes out of business. And that is the inherent risk that you get from investing into just one company, regardless of how safe you think it is. So instead, I invest in multiple healthcare companies, so I'm not just betting on one of them to win. So the best amount of stocks to own is exactly what it takes to achieve full diversification. The problem comes from the fact that no one can agree as to what diversification exactly means, because it's on a sliding scale. Now, in the online money, finance, investing, nerd world, if you ask that community how much they would consider to be fully diversified, you'll get a variety of different answers. But the most popular of these opinions is to own between 20 to 30 stocks to be fully diversified. But is that really true? In 1970, the Journal of Business published a paper that would then later become that popular opinion. And what they showed was that you could get the majority of the benefit of diversification of owning the entire New York Stock Exchange by owning only 32 stocks. And they showed this graph of risk versus the amount of stocks. And at around 30 is when you'd get the majority of benefits from owning basically the entire stock market. But that model was from 1970, and the mathematicians of yesteryear were not quite as smart as the mathematicians we have today. And in modern times, we found that risk reduction is not quite the same as diversification. It's one of the benefits, but the two are not the same. In an updated study done by Sir and Price, they used what's called the R-squared formula. And if you're interested, this is what it looks like. And let me read to you the textbook definition because I can't even. R-squared will give you an estimate of the relationship between movements of a dependent variable based on an independent variable's movements. Yeah, probably the same reaction that I had. But essentially, it's an accurate way of judging the correlation between a stock market's price in relation to a specific market index. Okay, I realize that probably didn't help at all, so I'll explain it one more time in simple language. If the end result of that formula is a low R-squared result, it means that specific stock generally does not copy the price movement of that particular stock market. And a high R-squared result means that that particular stock, the price of it generally copies and moves in the same direction of the overall stock market index that you're looking at. So using this updated R-squared method, they took the original study that concludes you need 32 stocks, and what they found was that you need 60 stocks to get 86% of the benefits of diversification for that specific market. When I say that specific market, I mean the stock market is a big, big place. You have small cap, mid cap, large cap, foreign growth, domestic growth, and the list goes on and on and on. In order to be fully diversified, you need to own stocks from all these different sectors like energy, tech, real estate, utilities, and again, the list goes on and on and on. But what they found was really interesting. When analyzing the stock market, 39% of stocks were completely unprofitable. 18.5% lost 75% of their value or more, and 64% underperformed the Russell 3000 index, which is something that tracks the entire US market. And 25% of stocks were responsible for the entirety of price increases in the stock market. So just think about that for a sec. Just 1/4 of stocks is what made all the difference in price increases. You would need to own anywhere between 2 to 5 stocks across every industry, of which there are hundreds of industries, just to be considered fully diversified. For example, let's take a look at my good friend's Jeremy from Financial Education's stock portfolio. He's an awesome dude and he loves his Tesla My Teslas. Now looking at his portfolio, he owns 12 stocks, but just by hearing that number out loud, I know that's not enough to be considered diversified. It doesn't mean he has a bad portfolio. In fact, he's doing incredibly well because the less stocks you own, the more volatility you have, which means the price increase is much more extreme, but so is the decrease. Now in Jeremy's case, in order to fully understand the bigger picture, we have to realize his gains. In other words, sell the stocks to get that money. Otherwise, it's like trying to count the chickens that haven't hatched. You can't fully understand the bigger picture until you go to sell. This is in contrast to the dividend strategy, which is where you get paid regular income on a scheduled basis, because that's the way that I like to invest. I like to think of passive income versus debt. If I have more money coming in than money going out, then I'm in a good place. Everything else is on paper, and maybe 5 years from now, what looks to be like a good performance is going to be far worse 5 years from now. I don't know. It's a different way of investing. It's not any better, it's just different. Now in Jeremy's case, he's doing really well because he put a large part of his money into tech stocks, which are doing really good. Now I own around 100 stocks in my portfolio that I keep track with my spreadsheet that tells me exactly what industry they're in, what sector they're in, how much income I'm gonna get paid exactly when, and it does it all automatically, which is nice. But I also have other investment tools that tell me how safe my investments are, and it compares my performance to the overall stock market and gives me bite-sized data to deal with, which is nice. But the problem with having so many stocks is that I don't have the time to sit down with each and every company day to day and see exactly where they're at, like Jeremy from Financial Education is doing. But that's okay, because I don't need to. I invest in boring blue chip stocks, and I don't need to know what Disney or Johnson & Johnson is doing on a daily basis to know that more than likely 10 or 20 years from now, they'll most likely still be around because they are mature, stable companies. Now, some people may look at my thought process and think, that is very amateur of you. That is very Robin Hood investor of you, Andre. And to some extent, that is true. Warren Buffett said, diversification is a protection against ignorance. And if you know what you are doing, it makes very little sense. Your second best idea is never as good as your first best idea. And that's true, because if I knew what I was doing, I would only own one stock, maybe two, and call it a day. But Warren Buffett, arguably the smartest investor in the world, doesn't own 2 or 12, he owns 50. So even Warren Buffett acknowledges his own ignorance. Therefore, he has no idea what he's doing either. No, I'm kidding. He might have some of an idea, but I don't know why you're watching my videos when there are far smarter people out there. Don't listen to me. But if there's one thing you can take away with you, it's that we are all ignorant with everything in life to some degree, especially about something as complicated as the stock market. So the quicker you can admit this simple fact to yourself, the less money you'll end up losing. The more humble you can be about your intellect and the things that you do not know, the farther in life you'll get, financially and otherwise. Take that and stick it on a fortune cookie. But as a general rule of thumb, the more of a beginner you are, the more stocks you should own. But better yet, you should own an exchange-traded fund, an ETF, that tracks the entire market, like VOO or VTI, which is something that I have in my Roth IRA account with M1 Finance, and it's a great option for me. But if you want to devote more time to this because you want to be an expert, then it's generally a better idea to own fewer stocks. But here's the secret. If you own an ETF that tracks the broader stock market, you will outperform the majority of professional stock pickers. And in my case, I've basically recreated my own ETF of the broader stock market that gives me a little more control and is a little cheaper, but the downside is that my performance is about in line with the stock market. So at this point, I might as well own an ETF, which is what I'm doing. I'm trying to get more ETFs that pay me dividends every month. Now, I realize there's a ton of people that are terrified of investing in the market, but please understand this one simple fact about the stock market, and that is fundamentals don't really matter right now. It doesn't matter how much a company's making money or losing money. You don't have to analyze PE ratios or anything like that. Usually that stuff is very important. But right now, as long as interest rates remain 0% until 2021, and as long as P. Diddy continues to print money and devalue the dollar, what it means is more money is injected into the economy. Therefore, it's taken more of that money to buy the same amount of stuff, which is why asset prices like real estate and stocks continue to go up in value. But the problem is, we just don't know how long that will last. As straightforward as I wish money and investing could be, I won't sit here and tell you should own 10 stocks. Because let's face it, number one, I can't make any ad revenue from a video that's only 5 seconds long. That's TikTok format, and it won't work here on YouTube. But number two, it depends on how much time you have, how much money you want to make, and how much risk you want to expose yourself to. More diversification isn't better. It means less risk, which generally means less return. Higher risk, higher reward. Now, personally, I don't like to take on a huge amount of risk, so I diversify. And with that, I sacrifice the greater return, but I sleep easier at night. So that trade-off is worth it to me, but maybe that isn't for you. So maybe you'd be better off with owning just 10 stocks that are more heavily weighted in the tech sector. But I can't answer that question for you. Only you can do that. So definitely let me know in the comments below how many stocks you own. I actually do want to know. And if you'd like to get started with investing, you can get 3 free stocks. 2 you can get from Webull by signing up for free. The first stock is valued at up to $250 in value. You can get a second free stock by funding that account $100. That's a free stock valued up to $1,400. You can get a third free stock from Robinhood, and there you go. You can follow me on Instagram. I post there from time to time. Love you. Enjoy the rest of your week. I will see you back here on Monday and Friday. Bye-bye.